In 48 hours, a single change in how oil gets paid for can reroute billions of dollars of demand away from the pipes that have carried global trade for half a century. Not months, not weeks, in 48 hours. They said the settlement system could never be meaningfully challenged because it was too large, too liquid, too embedded. And yet the market is now watching major commodity flows experiment with something that used to be unthinkable, settling outside the default dollar lane, even when the old system still looks dominant on the surface. The unsettling part is not that it is happening. The unsettling part is that institutions have been rehearsing it for years, while most people only see the headline layer, the contracts, the banking arrangements, the swap lines, the clearing decisions, the pilot transactions that look small until you add them up. If you follow the plumbing, you see the direction before you see the destination. And what I'm about to reveal changes the way you interpret commodity prices, currency headlines, and everything you think you know about who actually sets the rules. What makes this moment different is not one summit photo or one fiery speech. It is the quiet accumulation of settlement choices in commodity-heavy corridors. Russia and China have pushed the vast majority of their bilateral trade into rubles and yuan, with multiple public reports placing the share above 95%. India has trialed rupee settlement mechanisms. Gulf partners have tested invoicing and settlement that doesn't require dollars as the first step. And a BRICS-linked development lender is openly designing its balance sheet for a world where local currency financing is not an exception, but a permanent feature. Welcome to Channel Name. This is where we decode the signals that matter before they become the talking points everyone repeats. Think of it like listening to a wise elder who doesn't raise their voice but always seems to know what's coming because they watch the details. If you're listening from somewhere in the world right now, drop your location in the comments. It helps us see how global this conversation has become. Now, here is the event that crystallized what had been building in the background. On December 26, 2023, India's largest refiner completed a crude oil payment to the United Arab Emirates in Indian rupees, reportedly tied to roughly 1 million barrels. One transaction does not rewrite the world, but it does something more important than a headline. It proves the operational path exists. It proves banks can route it, counterparties can reconcile it, and contracts can be priced and settled without the dollar being the mandatory middle step. And in settlement, possible is the most dangerous word, because once it's possible, it becomes negotiable. And it happened against a backdrop that can mislead you if you only look at the scoreboard metrics. The official narrative says the dollar system is unchallenged because the dollar remains dominant in reserves, debt markets, and global payments. In the aggregate, that remains true. 88% of global payments value. That is a small number. If you stop there, you conclude that de-dollarization is mostly talk. But the data shows something else entirely when you stop looking at the world as one blended average and start looking at the specific lanes that move energy, metals, and food. To understand why that matters, you have to zoom out and look at how settlement regimes have changed before. Settlement changes slowly, then suddenly, because it is built on habit until habit is interrupted by incentives. In 1971, the United States ended the dollar's convertibility into gold. That was a settlement shock, even if it was framed as policy. The result was not an immediate dollar collapse. The result was a new era of floating currencies, commodity volatility, and inflation dynamics that forced governments and markets to relearn what money means when the anchor is removed. Now jump to 1998, when emerging market stress and the Russia default exposed how quickly liquidity can evaporate and how settlement confidence can fracture across borders. The playbook was familiar. Capital flight, currency pressure, and the realization that access to dollar liquidity can matter more than domestic fundamentals during a panic. Then look at 2008. The global financial crisis was not only a housing story. It was a dollar plumbing story. When dollar funding markets seized, global trade shuttered, and the Federal Reserve opened swap lines because the dollar system was the system. That episode taught a lesson markets rarely forget. In a crisis, the issuer of the settlement currency sets the terms. Then came 2014, when sanctions and geopolitical risk accelerated alternative payment discussions in places that had previously treated them as theoretical. And then 2022, when the scale and speed of financial restrictions reminded the world that reserve assets and settlement access can be constrained. Each time, the pattern repeats. First, trade partners search for ways to keep strategic flows moving without a single point of control. Second, institutions build or expand local networks, domestic messaging, local clearing, bilateral swap lines, and alternative settlement routes. Third, commodity corridors become the testing ground because commodities are where necessity forces experimentation. This is where the players matter because BRICS is a label, but the machinery is built by institutions. Development banks matter because they can create lending and liquidity in non-dollar terms. When a development bank says a quarter of its portfolio is in local currencies, and it aims for 30% by 2026. That influences contracts, procurement, and repayment schedules for years. Central banks matter because they can provide the backstop. Currency swap lines and bilateral arrangements reduce the need to source dollars during stress, and they reduce the power of a single funding market to dictate terms to everyone else. Payment system operators matter because they translate intent into technical reality. Messaging systems determine who can send instructions to whom. Clearing systems determine finality. And in finance, finality is power because it decides what counts as settled when markets are volatile and time is expensive. Commodity exchanges matter because they turn physical goods into standardized contracts. If you can trade in oil, gold, copper, or wheat on an exchange that clears in a local currency, you can create price discovery that does not automatically flow through the dollar first. Banks matter because they provide the balance sheets. If banks are willing to intermediate local currency commodity settlement, the market stops being a theory and becomes a service. Now, look at the institutional movement that is easiest to see in real-world behavior. Russia continued exporting energy and commodities, even under restrictions, but the settlement mix shifted toward currencies that reduced exposure to the dominant rails. China, as the world's largest commodity importer, has steadily expanded yuan usage and trade with partners willing to recycle yuan into Chinese goods, Chinese assets, or into swap line structures. India, as a major importer, has pushed for rupee settlement not because it wants a dramatic regime change, but because it wants to manage external pressure points and preserve flexibility when global dollar conditions tighten. This is not coordination in a secret room. It is coordination through incentives and timing. When sanctions risk rises, alternatives become more attractive. When interest rates rise, dollar funding becomes more expensive and alternatives become more attractive. When local currency liquidity deepens, transaction costs fall and alternatives become more attractive. You don't need a conspiracy to explain this. You need to watch what happens when a business faces a choice between a cheaper, smoother route and a route that has higher friction, higher uncertainty, and higher costs. Here's where it gets interesting. If you only read headlines, you might think the world is rapidly abandoning the dollar. If you only look at global payment shares, you might think nothing is happening at all. Both impressions can be wrong at the same time because they are looking at different layers of the system. The dislocation lives between stock and flow. The stock is the accumulated dominance of the dollar in reserves, debt markets, and legacy invoicing habits. The flow is the marginal settlement choice for new trades in the most sensitive corridors. Stock moves slowly, flow can change quickly, and flow is where tomorrow's pressure shows up first. So what are the two data points that tell opposite stories? 88% of global payments value in mid-2025. The other is corridor-level settlement data showing local currency usage rising sharply in specific lanes, such as reports that Russia and China settle above 95% of their bilateral trade in local currencies. One says the dollar is everywhere. The other says, in the lanes that matter most to strategic autonomy and sanctions resilience, the dollar is increasingly optional. That gap cannot persist forever without consequences, because it changes hedging behavior, liquidity premiums, and who holds the bargaining power during stress. Let me show you what this actually means with numbers that anchor the story. 88%. That tells you the yuan is still small in the aggregate. Now compare that to the concentrated usage in strategic corridors. A currency can be small globally and still be decisive in a specific lane, if the lane is large enough and the participants are persistent. Now add the precedent transaction. A roughly 1 million barrel crude payment in Indian rupees on December 26, 2023. That tells you something practical. The settlement chain can close. Not in theory, not in a white paper, but in an executed transaction. And then layer in development finance. A target like 30% local currency lending by 2026 is not designed to impress retail audiences. It is designed to build an ecosystem. Lending creates long-lived liabilities and assets. When borrowers are serviced in local currencies, suppliers are paid in local currencies, and contractors hedge in local currencies, the market infrastructure deepens. It becomes easier for banks to price risk, for exchanges to clear contracts, and for central banks to manage liquidity. Slowly, the ecosystem grows. And ecosystems, not announcements, are what change settlement regimes. But the evidence is not only in currencies. It also appears in the behavior of commodities themselves, in the tension between paper prices and physical flows. Markets can look calm on a screen while stress builds in the supply chain. When settlement options widen, physical flows can reroute, even if benchmark prices don't immediately scream. You can see it when certain regions lock in long-term supply deals while others rely on spot markets. You can see it when inventories build in one geography and drain in another. You can see it when the same commodity trades with different premiums in different hubs because financing and settlement conditions are not identical. This is the part no one is discussing enough. Settlement is not just how you pay, it is how you finance. When a commodity is priced and settled in dollars, the entire financing ecosystem around it is dollar-based trade finance lines, letters of credit, hedging instruments, collateral arrangements. When settlement begins to shift, the financing ecosystem must adapt. Adaptation creates frictions, and frictions create dislocations. Sometimes, the dislocation shows up as a persistent basis spread between regional benchmarks. Sometimes it shows up as tighter credit terms in one corridor and looser terms in another. Sometimes it shows up as forced rerouting, where the same physical trade becomes more expensive simply because the settlement plumbing changed. Now, how does this get executed in practice? It is less dramatic than people imagine, and that is why it works. Think of the global settlement system like a highway network. For decades, everyone drove on it because it was the fastest way to move goods. But it also has toll booths and checkpoints, and under certain conditions, those checkpoints can tighten or close. What BRICS-linked corridors are building is not a brand new planet. It is an alternate set of routes that may be narrower at first, but that cannot be easily blocked by a single authority. That changes risk calculus, even if it does not change the headline share overnight. Mechanically, the steps are straightforward. A buyer and seller agree to invoice in a local currency, or to settle through a conversion that happens without relying on the dominant rails as the mandatory path. Banks arrange the exchange and the clearing. Sometimes central banks provide swap lines so local currency can be obtained without stressing dollar reserves. Sometimes trade is balanced through reciprocal flows, where the exporter uses the importer's currency to buy goods, services, or assets from the importer. Sometimes a development bank provides financing in local terms, which creates steady demand for local currency settlement over many years. Then there's the pressure mechanism that accelerates adoption. When access to the old system becomes costly or uncertain, the new system becomes attractive even if it is less convenient. Higher interest rates increase the carrying cost of dollar financing. Compliance risk increases friction for dollar settlement in certain corridors. Sanctions risk increases the possibility of delays, freezes, or forced rerouting. Even if the alternative route is imperfect, it can be good enough. And good enough is how parallel systems are born, because perfection is not required when necessity is pulling the market forward. So what does this lead to? Historically, when settlement shifts begin in commodities, the outcomes tend to follow a few recognizable paths. The conservative scenario is coexistence. The dollar remains dominant globally, while a meaningful minority of commodity trade settles in alternative currencies within specific corridors. In that scenario, volatility increases around stress events because markets must price two liquidity regimes at once. The moderate scenario is fragmentation. Multiple pricing centers gain credibility, and regional benchmarks carry more weight because settlement and financing are regionalized. In that scenario, spreads between hubs become more structurally important, and sudden repricings can happen when liquidity moves between regimes. The more aggressive scenario is that in key strategic commodities, enough settlement migrates that the dollar becomes optional in moments when it used to be mandatory. And the moment a system goes from mandatory to optional, the leverage shifts. It becomes harder to force uniform terms across all participants. It becomes harder to assume a single funding market will set the global price of credit. It becomes harder to assume that a single benchmark tells the whole truth about supply and demand. Notice what none of these scenarios require. They do not require the dollar to disappear. They do not require everyone to suddenly reject U.S. assets. They require something simpler. That enough strategic commodity flows find workable alternatives so the dollar becomes a choice rather than a requirement in key markets. And once that happens, the pricing of risk changes. The value of liquidity changes. The bargaining power in long-term supply contracts changes. Even the meaning of a safe reserve asset can change at the margin because safety is partly about access, and access is partly about settlement routes. But there is another layer that makes the commodity angle so powerful. Commodities are not only traded, they are warehoused, pledged, and used as collateral. A barrel of oil, a ton of copper, or an ounce of gold can sit behind credit lines, margin agreements, and trade finance facilities. Collateral is the lifeblood of the plumbing behind visible markets. When settlement stays inside one dominant currency system, collateral chains are standardized and widely accepted. When settlement begins to split across currency zones, creating basis, spreads, and collateral mismatches that show up later as volatility. This is why experts can contradict each other and both sound credible. One expert points to global payment shares and says the dollar remains dominant. Another points to corridor settlement deals and says the dollar is being bypassed. The contradiction is real because they are measuring different layers. One is measuring breadth, how widely a currency is used across all kinds of payments. The other is measuring intensity, how critical the lanes are where a currency is being used. A currency can be small globally and still matter enormously in a handful of strategic commodity lanes. Consider how a refinery actually buys crude. The deal is not a single transfer. It is a chain, contract terms, shipping schedules, marine insurance, letters of credit, inspections, customs documentation, and then final settlement. If the settlement currency changes, every link in that chain has to be able to price, hedge, and reconcile in that unit. That is why the first transactions look like tests. They are not tests of desire. They are tests of plumbing. When India's largest refiner paid the UAE in rupees for roughly 1 million barrels, it showed that the chain can close without defaulting to dollars. Now zoom out to the institutional chessboard. Major producers care about reliable demand and predictable payment. Major consumers care about reliable supply and predictable financing. The dollar system historically offered both, but it also concentrates leverage in one set of rails. So institutions build redundancy. Central banks expand swap lines and diversify reserve composition, not to replace dollars overnight, but to have options during stress. Domestic payment systems are upgraded, cross-border links are built, and banks start offering products that make the next transaction easier than the last. Then the market begins to price the difference between paper optionality and physical necessity. Paper optionality is what a trader sees on a screen, the ability to buy and sell a contract instantly in a deep market. Physical necessity is what an industrial buyer faces: a ship arriving, a factory needing feedstock, a power plant requiring fuel. When physical necessity meets settlement friction, behavior changes first and prices adjust later. That is how dislocations are born. It is also why they can persist longer than anyone expects, because real industries cannot pause while finance retools. There is also a subtle distinction that almost no headline explains. A commodity can be quoted off a dollar benchmark and still be settled in another currency. Quoting is a reference point. Settlement is final delivery. Two parties can reference a dollar price and still pay in rupees, yuan, or dirhams after conversion. The difference is where the conversion happens, who provides the balance sheet, and what rails deliver finality. When those rails multiply, bargaining power shifts, because parties can negotiate for more than one reference point when risk rises and liquidity tightens. And this helps explain why the trend can feel invisible until it shows up as a shock. The world does not need half of trade to move away from dollars to create stress. A much smaller shift can matter if it happens during crisis moments or in concentrated lanes. In 2008, what mattered was not that the dollar was weak. What mattered was that everyone needed dollars at once. In a future stress event, what will matter is how many participants have viable alternatives, how quickly they can access them, and who can access liquidity when everyone else is scrambling. What should you watch? Not as a prediction, but as a pattern indicator. Watch the share of bilateral trade settled in local currencies in major commodity corridors. Watch central bank swap line announcements and usage. Watch development bank lending composition, because it tells you what balance sheets are being built for the next decade. Watch the growth of non-dollar commodity contracts and the willingness of large producers to accept settlement in alternative units. Watch regional benchmark spreads and persistent premiums, because they often reveal financing and settlement stress before the mainstream narrative catches up. And finally, watch the narrative gap. When the public conversation swings between nothing is changing and everything is changing, that is usually a sign that the shift is happening in a layer most people do not monitor. There will be those who watch only the old scoreboard, reserve shares, global payment shares, and legacy benchmarks. And there will be those who watch the plumbing, settlement terms, corridor-level flows, and the slow institutional build-out. The divide is not about being smarter. It is about watching leading indicators instead of lagging indicators. This is why the question is not whether the system is changing. The system is always changing. The question is whether the change is happening in a layer you are watching. If you only watch the ocean, you miss the canals. If you only watch the canals, you miss the ocean. But if you watch both, you understand how the same month can produce headlines, saying the dollar is unchallenged, while the settlement, plumbing, and strategic commodity lanes evolves. This is channel name, where we decode what matters before its headlines. If this connected dots you hadn't put together, you know what to do. Because the question isn't whether this unfolds. The question is whether you recognize the settlement shift early enough to understand the moves institutions are already making, long before the crowd realizes the rules of the game have updated.